Home prices are down across the capital cities on average 2.5% in this year to July. And that's been forcing property developers like Meriton owner Harry Triggerboff to reassess their projects.
We are not buying land at the moment. We bought the last land about 2-3 months ago, but we'll be back soon.
Well, in the year to July, unit prices haven't fallen as much as house prices. On average, across capital cities, unit prices are down 1.5% over the year to July versus a 2.5% fall for houses. And that may have to do with the fact that the top end of the market has fallen much faster than the middle or lower segments of the market, down well over 5% from the peak so far this year. And compounding the problem, the RBA's next move in interest rates is likely to be up, albeit not for a while, and the banks have been forced to tighten their lending criteria in the wake of the Banking Royal Commission. Digital Finance Analytics says borrowing capacity has fallen starkly for most income brackets. For example, for those earning $80,000 a year, they're now able to borrow 42% less than they were before the Royal Commission started. Joining me now is Martin North, the head of Digital Finance Analytics. Martin North, given those figures I've just put up, does it mean that many are going to find it hard to get into the market or upgrade their current home?
Yes, I think the first issue is that anybody trying to refinance, if they've got a higher loan to value on their property or income constraints, will find it very difficult to be able to refinance to those new really cheap deals that are out there. About 40% of refinances are not actually being accepted by the banks compared with 5% a year ago. And if you're a first-time buyer, then the hoops you have to jump through in terms of exposure to expenses and all those other things means it's way more difficult than it was to get a loan. So this is really a very strong tightening.
And is it the Bank Royal Commission the only reason lenders are tightening their standards at the moment, or are there other pressures on them?
No, there's a whole bunch of things. So if you look at over the last couple of years, the regulators have been pushing down quite hard. We've seen the Royal Commission, of course, highlight the fact that the lending standards are way too loose. So all of these things are coming together, plus the fact that the banks are trying to chase low risk, low LVR business because they want to grow their books even now in this environment. So effectively, they are trading off low risk to high risk. If you're a high risk customer, you'll have to pay more. You can't refinance. If you're a low risk customer, they're welcome with open arms.
Well, we heard a warning from Westpac last week that its net interest margins are under pressure given its funding costs are rising. Would banks be raising their mortgage rates if they felt they could in this environment?
Well, there's no doubt they're under some funding pressure, but of course there's also public pressure, partly from the Royal Commission and partly just because of where the banks are in people's psyche at the moment. But the pressure on margins is insidious and continuous, and I think at some point one of the big four is going to have to start moving their rates up for some. But what they're doing at the moment is they're effectively stealing margin from that back book, the more expensive borrowers, and are giving it to those new borrowers to try and attract them in. That'll go on for a bit longer, but I think down the track, some mortgage rates will definitely rise.
So switching providers would be a good option?
I think it's definitely worth shopping around. What I would say is, though, that some of those people who are less good risks may be allured by the non-bank sector, but they will tend to have higher rates on offer. So you want to do your homework and be really careful about assessing whether the deal is really as good as it may first seem.
And sure, in terms of the outlook for the housing market, briefly, what's your expectation around prices? That's the million-dollar question.
Down. Firmly down. We haven't really seen very much yet, but although the averages aren't showing up a huge amount, there are some postcodes where they're already down 22% in Sydney and in Melbourne. And my expectation is that this is going to be a continuing slide through this year into next year. And, no one quite knows how quickly or where the end stop is. But I think this is fundamentally different because it's driven by lack of credit availability for the first time in about a generation.
And the potential that the RBA could raise rates?
Well, the RBA may raise rates. My own view is they will probably be forced to cut rates into next year as the economy eases and as home prices continue to fall. The chances of rates going up very much from the central bank is quite low, but out-of-cycle rates from the lenders is a much surer bet.
Martin North, as always, we appreciate your analysis. Thank you.
Good to talk to you.